Hussein Allidina is the head of commodity research at Morgan Stanley. He joins us now live. Hussein, welcome to InBusiness. USDA forecasts food inflation is going to be 2 to 3%. Given the kind of run-up that we've seen in wheat, in sugar, and other soft commodities, is that a fair expectation for the consumer?
I think there's probably a little bit more upside to that than the USDA's number. Really, the reality here is that the balances across many of these commodities that you mentioned, sugar included, are very tight. And with any sort of incremental weather disruption like we've seen this year out of Russia, Pakistan, most recently out of Australia, the upside is actually quite significant. We don't have inventories to handle any of these disruptions.
So food inflation above 3, you want to put a specific on that, specific figure?
Actually, I don't forecast food inflation. I'll forecast the individual commodity prices. So we do think corn trades well above 6 right now. We think corn's got to go close to $8 a bushel before you can cut off discretionary ethanol blending, which you need to do. Soybeans have upside from current levels. And sugar right now at 30-odd cents. If we do have any incremental disruptions in the Indian harvest or out of Brazil in the coming months, there is further upside.
Okay, so it's based off of that you're extrapolating the inflation assumptions. But
yeah, exactly.
Talk to me. Fed Chairman Ben Bernanke is answering questions right now on Capitol Hill. One of the things he was just asked about is oil. I mean, we're seeing almost consensus forecasts of triple-digit prices for oil back above $100 a barrel. He says it's not QE2. He says it's emerging market demand that's driving us. Is it?
Absolutely. Emerging market demand has been very firm. If you look at the data out of China, Chinese demand has pressed a record high for 2 consecutive months now, 9.5 million barrels per day. So demand is very firm, but it's also demand in the OECD. If you take a look at data here from the U.S., we're averaging up over about 4% year on year. So you're seeing a little bit of a cyclical improvement in U.S. demand, and this is all against the backdrop of a very tight supply side and a tightening supply side. The ability for us to grow our production is challenged. You see this in the data from 2002 to present. You haven't seen a real material increase in production at the same time that demand has continued to increase.
So how expensive is oil now versus where it was back in 2008, the last time that we saw oil, trading above $100 a barrel, given what we've seen in the currency markets?
Well, I think obviously the weakening in the dollar does play a role in sort of impacting the crude price. Today we're trading at about $90 a barrel, $95 a barrel in the Brent contract. There's upside to these numbers. We're forecasting a crude price of $100 a barrel next year. This is driven by the firm's GDP forecast, 4.2% globally. Again, 70% of that GDP growth comes largely from the emerging market. I see further upside from here. Right now, balances are just starting to tighten. OPEC is going to come into the market, I believe, in the first half of this year to increase production. That will temper spare capacity, and I think that gets the market really focused on the issues facing the supply side, something that we've been a little bit ambivalent to really over the last 2 years because of the concerns on the demand side.
The interesting forecast there on OPEC. Talk to me, though, with the kind of riots we just showed happening in Algeria. Back in 2008, when we saw the food crisis, we did see individual countries start to ban exports of foodstuffs. Given what's happening globally with this, 30-something% run up in the price of food, given what's happened with cotton and the price of just making clothing, do you expect to see more export bans?
Absolutely. We've already seen this year Russia and Ukraine limit wheat exports after the droughts they saw respectively in their countries. I'm not going to call out individual countries, but if you look at history over the course of the last couple of years, as corn prices increase, as soybean prices increase, countries in the Western Hemisphere have a tendency of imposing export restrictions in order to contain domestic inflation. And I anticipate we're going to see the same thing as we move through 2011. I'd say that the balances today in food and corn, soybeans are arguably tighter than they were in 2008. This is much more of a fundamental story vis-a-vis where we were in 08.
Hussein, we left it on food. It sounded like you were describing another food crisis.
Yeah, absolutely. It's the concern today, as I was saying, is that inventories are tight and we cannot afford to have any sort of incremental weather disruption. Today in Argentina, you've got dry weather that is really slowing the pace of the development of the corn crop, the bean crop. And if you look at the U.S. balance, the U.S., of course, is the world's largest exporter of corn, second largest exporter of beans. We cannot afford to export an incremental bushel if there is a disruption in Argentina. Stocks to use in the U.S. are standing at 6% in corn. This is the lowest level we've seen since 95, 96. And you don't have that spare capacity to increase your acreage this spring. spring.
Quickly on the metals, we focus so much on gold as sort of a currency play. You're finding opportunities, though, in copper, nickel, and tin. Those are your safest bets right now?
Yeah, that's right. If you look, again, at the fundamentals in those markets, you've got a tightening supply side, not a whole lot of greenfield production coming online, at the same time that you've got continued robust demand out of the emerging markets, China especially, but also a resurgence in the OECD. So it's a similar story where the supply and demand is actually tightening to provide the upside here in price.
All right. Thank you very much, Hussein, for sticking with us there.